Your time horizon is deeply tied to your asset allocation and investment success. In this video, we'll explore how time is critical to understanding and navigating the market for your own portfolio. Whether you're a seasoned investor or just starting out, understanding the power of time significantly improves your chances of growing your wealth. The magic of compounding can work wonders for growing your portfolio, but equally important is the commitment to staying invested within your time horizon. Your time horizon refers to the length of time you intend to hold on to your investments before needing to spend a good portion of them down, and it varies on your personal circumstances. For instance, someone early in their career would have a very long time horizon before they need to tap into their investments. On the other hand, if you've already started retirement, then your horizon might be a little shorter. A longer time horizon generally means that a portfolio can take on a greater amount of risk with higher exposure to equity investments, which are more volatile but offer more return potential. A shorter time horizon, on the other hand, usually necessitates a lower amount of risk and, as a result, a greater allocation to fixed income investments, a lower but more stable returning asset than equities. Time holds the most power for long-term investors. In this video, we are focusing on investors with a long time horizon and on the value of starting early. One of the most compelling aspects of time in investing is the phenomenon of compounding. As your investments generate return or profits, these gains can then be reinvested for even more return. This compounding effect can exponentially grow your portfolio over time, regardless of the shorter-term market fluctuations. The longer you let this process continue, the more significant the compounding benefits become. To illustrate compounding, imagine you're given two options. You can have a penny that doubles every day for 30 days, or a single payment right now of $1 million. Which would you choose? It might surprise you to learn that picking the doubling penny is the better choice. As that penny doubles, the balance grows to over $5 million by the 30th day. Note that much of the wealth has been made in the last few days, which is how compounding works and emphasizes the importance of investing for the long run. On day 27, that initial investment of 1 penny is about $671,000, but by day 30, it's grown to over $5 million. This example is a bit extreme, so let's look at something more realistic. Compare two investors, Blake and Taylor. In the year 2000, both invest $10,000 in the S&P 500. Blake becomes fearful after the Great Financial Crisis and moves his money to cash. He avoids the Eurozone debt crisis, the fiscal cliff, the COVID-19 pandemic, high inflation, and one of the most aggressive rate hiking cycles in history. Taylor, on the other hand, never goes to cash. She stays invested through it all. How did they both do at the end? Well, Blake locked in a 39% loss on his initial $10,000 investment the day he went to cash. Taylor, however, enjoys a 161% gain despite experiencing several significant downturns in the market, commonly referred to as bear markets. While the 2000s were an unusual decade in which investors lost money during a 10-year period, it's actually very uncommon to lose money in the stock market over a 10-year period if you have a well-diversified portfolio. Historically, investors in U.S. stocks over 1 year generate a positive annual return about 75% of the time. If you extend that to a 5-year period, it's almost 90% of the time. And over a 10-year period, 95% of the time, the return is positive. If you expand that to a 15-year period, there has never been a 15-year period that ended in a loss. Going back to Blake and Taylor, you may be thinking that Blake should have realized that the economy was improving and he should have invested back into the stock market. That certainly would have been better than staying in cash. However, timing the market is notoriously difficult. You have to know precisely when to exit and when to re-enter. Most investors don't get those two moments right. Instead, they tend to lock in losses and miss out on returns. A painful double whammy. Particularly because it's very common to see the market bounce higher right after a downturn. By the time investors realize that it's a better economic environment, it's too late. Timing the market is extremely difficult, and even the most seasoned investment professionals realize it's a fool's errand. Missing just the 10 best days can cut your return opportunity in half. It's important to remember that the market is a forward-looking mechanism. Even if we're expecting an economic downturn just around the corner, the market may have already accounted for that and be performing well as investors look past the expected turmoil. While time is crucial, maintaining patience and staying invested is equally vital. It can be tough to weather market volatility, but exiting during a downturn can turn temporary losses into permanent setbacks. Don't be tempted to make drastic changes in your investment plan based on short-term information. The global economy and news headlines will always give you a reason to be cautious. Beyond that noise is an entire universe of businesses that form the base of our global economy. Within this universe are many great companies with creative, innovative leaders and good business fundamentals, which continue to offer compelling opportunities for long-term investors. In our next video, we'll dive deeper into equities, exploring how they fit into your investment strategy.